What is your read right now as we see this spread getting tighter and tighter on what the bond market and investors there are trying to balance?
Right. Typically, when you see the curve flattening to those levels in this trend and with this sort of speed that we've been seeing, particularly from late last year and into this year, it's effectively telling you that policy is getting tight. The flattening argument is that eventually the central bank will have to give back some of those hikes and therefore tighten potentially too much for the economy to bear. And hence why we're seeing this type of trend in markets, which has probably been one of the more persistent trends for several months now in fixed income.
James Bullard said on CNBC yesterday to our Steve Leisman that the Fed's credibility is on the line with the decisions that they're going to be making about monetary policy. Based on your expertise in fixed income, what do you believe the Fed needs to be doing?
Well, the response from the Fed is the sort of response you would want to see when you have the kind of inflation prints that we've been having, right? So we're talking pretty elevated prints. I guess from a market's perspective, it's about the pace of that, hiking cycle that they are introducing. So on the one hand, the Fed's being very reactive to the inflation prints that we've gotten. On the other hand, as the curve, for example, the flattening of the curve is telling you, that could be potentially a little bit too much for risky assets. So with that in mind, that's why we're seeing this increased correlation between asset prices and why a lot of the riskier asset markets are reacting negatively when we see those much higher yields on certain trading sessions.
Inflation has been so hot, hotter in many cases than was expected when we see the reads that come out monthly, and certainly at the strongest pace since 1982. Is there anything that the Fed can do with monetary policy, with the tools that it has available to curtail this? Or is some of this just time and the supply chain and the shortages that we're seeing there alleviating through their sort of own systems of working their way through?
Well, I think you're absolutely right. In terms of the supply chains, it's very little the Fed can do. That's a dichotomy that economies will work through, as you correctly point out. It can do a lot, though, in terms of confidence. So it's about the Fed's credibility in terms of targeting inflation. And therefore, to that effect, the response we've had and the pricing of break-evens, which tend to elude how much inflation premium is in the market, have come off. And still, the longer term vectors of those break-evens are lower. So they're not telling you that the market's particularly worried about inflation, say, in 3 to 5 years' time. It's more the shorter term nature of it. So could you argue that potentially they are going pretty rapid when we've potentially reached or are close to the peak in those numbers? It's possible, very difficult to say, but they do appear to be fairly nervous about the prospect of this higher inflation prints feeding through into higher surveys, i.e. the average person in the street looking at a much higher inflation conundrum further down the road. That's the risk of central banks, and that's why they're responding so hawkishly.